said a little earlier that you have tried to put it together twice. What makes you think that this 12 billion rand transaction, where Redefine is going to acquire the assets of Madison and ApexHi and make one big super company worth nearly 20 billion, will go through this time?
Thanks, Alec. I think this time round the swap ratios make sense. Last year the market was very volatile. It was just impossible to. You looked at something on one day, the next day it had changed, and it wasn't moving in sync. What we did this time around was we focused on the income of each of the funds, decided who got punished and who didn't, and took the view that the share price, if we got the income right, then in terms of the ratios, everybody should be a winner. And just looking at the close of the markets today, it's almost happened exactly like that, a few cents out, but they're almost tracking the swap ratios now against Redefine.
It's got to be a tough sell because you've got a lot of institutions that are shareholders.
Well, the initiative really came from the major shareholders who wanted to see it. And I think really what happened was also when we tried in the middle of last year, we tried to say to institutions, look, size and liquidity are going to be important for two reasons. A, we think it'll improve the rating. And B, we believe then and believe more so now that we're going into stormy waters and choppy seas. And as somebody who cruises quite a lot, I know that the bigger the ship, the less rocky it is. So really with that in mind, we've had support from the major shareholders to do it. The test now is to see whether they like the swap ratios, and I think that they work. I think they work for everybody. Everybody's a winner. You lose on income, you gain on cap value, or vice versa. And I think that this time around it's got a very, very good chance of success.
It's well known that there's rocky seas coming, but are the share prices of the property sector on the JSE already discounting this properly?
I don't know, Alec. When I look at the sector, and I'm not talking about our shares, and I look at the highs and lows over the last 12 months, we've recovered probably on average about 40% from the lows and are probably 20% off from the highs. So maybe too much too soon. I think the market is anticipating a number of rate cuts, and that comes through. But clearly, and we haven't seen it yet, if the economy stays the way it is, there has to be casualties. So we can say we're defensive and all those kind of things, but across the board, all funds are going to have tenants who are going insolvent or out of business, and obviously that impacts income to a greater or lesser extent depending on the makeup of your fund. So yes, it's going to be a tougher year, but
there's not a place to hide just yet.
Look, I think if you look at the yields, it depends on the view that you take. But if we're going to get a 350 basis point cut in interest rates over the next 12 months, and our growth drops from 13% to 10%, and you're getting 9 or 10% yield, well, then I think it is quite a good place if you need income. Mm-hmm. I don't think we're going to get the same kind of yield compression that we saw previously, but I think yields will come down as interest rates come down. And clearly, in terms of this merger which we've mooted, if we follow the growth point kind of example, and we do get into some of the indices, then I think there's substantial upside in the share in terms of the re-rating.
You've been talking as a shareholder and as an investor, but now as a landlord, because you are one of the bigger landlords in the country, what is likely to happen to rental increases this year?
I think it depends on which sector you're in. I think retail is going to be quite difficult because, as we know, although we're getting very mixed signals, David said earlier, we talked about Truworth 17% up, ShopRite 25%, Massmart. So we're getting mixed signals, and it's coming across different centres in different places. But over and above the fact that sales are static or dropping in retail, we're also faced with higher electricity costs, higher rates. So the cost of occupation for tenants is high and is making it difficult for us to get real growth out of rentals that come up. In the office sector, I think we're still going to see growth because the credit crunch has resulted in the banks withdrawing a lot of funding from speculative developments. So a lot of new developments which were planned, the bank now wants to see 25 or 30% equity, 60% pre-let, and those are not going to happen. So in terms of existing office space where we still got very, very low vacancies, I think that's very positive. And in the industrial market, which has had a very good run, I think there we are susceptible to casualties quite quickly.
Mark Wainer is an executive director at Madison, and today's big announcement that Madison is going to be part of a merger, or so Mark hopes, with Redefine and ApexHi.